everyone, and welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, there's been two broad themes in the markets today, the first of which won't come as a surprise to anyone who's been following the story over the last days or weeks, and that is in relation to the OPEC deal, which was reached yesterday. Now, I, like many other people, were very skeptical that OPEC would reach a deal itself. Yet a deal itself has been reached. I should stress that this was only one hurdle that is going to be facing the oil cartel. The other major hurdle is actually carrying out said deal, which has proved more difficult in the past than you would expect. The deal itself reduces the amount of oil being produced each month by OPEC by 1.2 million barrels a day, from just under 33.7 million barrels a day down to 32.5 million barrels a day. Saudi Arabia is going to play a large part in that reduction, reducing their output to just over 10 million barrels a day, which is down by around 500,000. The deal itself is dependent on two factors. The first one is OPEC members abiding by the agreement. The second one is non-OPEC members reducing output by 0.6 million barrels a day. Half of that is going to fall on Russia. So you can see there's a lot of factors that are still to come into play here. The deal would take place from Jan. It'll last 6 months till the middle of next year and may be extended further. That is a long time for members to renege on this deal, which wouldn't be the first time something like that has happened. And I think it's also important to stress some of the wording which we've heard even since the deal was announced. Things like Russia stressing that from January they will look to reduce their output by up to 300,000 barrels a day. A few other non-OPEC members have made similar remarks. This isn't the type of committed language you'd expect, and plus that really brings into question, well, if this is happening from the 1st of January, then what are these member nations going to do between now and January? If they ramp up production, are they reducing levels from now or from the 1st of January? Things like this, these little details can impact just whether the deal is actually carried out as planned. It's also worth stressing that this now brings this would bring OPEC output from at 32.5 million barrels a day, back in line with what they were producing in January this year, when there was an oversupply concern already. So it sounds like a large cut, but in reality, because OPEC has been increasing its production to these new record levels on a monthly basis, we're actually just now back at January levels of this year. So what the OPEC's really relying on in order to bring this market back into balance is not only its own members to fulfill their commitments, but also for global demand to continue to pick up in order to soak up that excess supply. So like I say, there's a number of things that could go wrong in the process, but for now the first hurdle has been cleared. We saw up to 9% gains in oil yesterday, and as you can see by the ticker on the right hand side here, we're now up another 3.5% in Brent crude today. We're through $50 a barrel, which is an important psychological level, but as I said in yesterday's video, if we were going to get a deal, I think $50 would be the first hurdle, but ultimately it wouldn't surprise me if we're trading back at around $52, $53 a barrel, which is where we were trading at when OPEC initially agreed to reduce production to between 32.5 and 33 million barrels a day where at the meeting in Algeria. The question is, can we actually move beyond here? Now, in the short term, it wouldn't surprise me if we do see a move between $50 and $55 a barrel. I don't think there's going to be much momentum or much desire to push beyond here at this stage, because of the challenges still facing this deal and because of the fact that it is still a very oversupplied market. But I think $55 is very possible. For now, the first hurdle, of course, comes around $52.50 to $53. But if we do trade higher, then like say 55 wouldn't come as a huge surprise, and it would also be a nice little technical resistance as well, having been a prior level of support. In WTI crude as well, again, we are trading higher. I do think there is further upside to come in this. I think $53 to $53.50 is notable resistance, with it being high, the post Algeria high. Beyond here, then we could be looking again at 55 to $55.50, again this prior zone of support, and I think we could see further resistance at these points. But again, I guess this is one of those things you've got to wait and see. It's easy indicating key levels, but trying to anticipate where exactly it will stop is a lot more difficult ahead of time. It'll be very interesting to see how we react at these $53 levels. There's a reason why prices were capped at these levels after the Algerian meeting. So that would suggest to me that this is around where the market sees a fair value. The reason why I think we could potentially go above is simply because there's a difference between coming to an agreement and releasing details of the agreement, and that's what I think could take us through those $53 barrels. But again, let's just wait and see how we do respond at those previous levels again. Now, I saw in one of the comment sections that someone asked me to cover CAD. We did cover it in the previous video. Coincidentally, I only saw the comment after it because it was related to the oil deal. Let's take another look and see how the Canadian dollar has responded to the completion of this deal. Now, we saw it reverse those gains yesterday. I think that was driven by dollar strength rather than CAD weakness. We did see Canadian dollar strengthen on the back of the deal being done. We saw dollar strength shortly after, which is why I think we moved back towards these 134.50s. We are seeing the Canadian dollar strengthen again today, in line with those 3.5% gains that we are seeing in the oil markets. But again, we have run into support here around these 133.75s, and it does seem to be catching a bit at these levels. Where if we can see a move back lower again, we are still trading in this channel at this moment in time, so I think around 133.40, 133.50 we are still going to see it potentially catch a bit. A break low would be quite bearish and could signal a move back towards these 132.50s, but for now it does seem to be catching a nice bid around those 133.70s, 133.75s, which is quite difficult to ignore at this stage, and would suggest there's still plenty of buyers at this level. If we could even see it move back towards these 135s in the short to medium term. This is not one of the more bullish or typically bearish markets that we're seeing right now. I think given how closely interlinked both of these, the US and Canadian economies are, I guess that shouldn't come as a big surprise. But we're not seeing any. I'm not seeing any massive breakout potential there at this moment in time on a daily market perspective. With oil out of the way, let's talk about the other major story today, and that relates to the pound. We heard from Brexit Secretary David Davis today, who claimed that they would consider paying into the EU in order to get access to the single market. You remember that this was one of the big controversies during the Brexit campaign, was that we were told repeatedly that we were paying £350 million to the EU, and that something like that could fund the NHS. Now, there's a few tall tales within that, because as we get some of it back as a rebate. There was some of the money which we get back in terms of subsidies for certain industries, and other we get money back in other ways as well. Now, obviously, there is still a net spend from the UK's perspective, but that entire 350 million was never going to come back in addition to what we already receive. But now there's talk that from David Davis that we could pay into the EU in order to try and get access to the single market. It is worth noting that the EU, on the other hand, has said the only way to get access to the single market is through accepting free movement of people. So these two sides are very contradictory. But what the market has responded to is not the expectation that we're now going to get access to the single market. It's a softening in the stance of a key Brexiteer and one of the people who are going to be in charge of our Brexit negotiations. Now, you'll remember that I also said in yesterday's video that there does seem to be upside desire for the pound. We are seeing it push higher. It's been one of the most resilient currencies to the US dollar. There's a number of reasons for this. The change in stance from the Bank of England is one of them. The fact that we haven't had a significant deterioration in the data is another, and the softening of the Brexit stance is a third. And I think this comment today hasn't necessarily changed people's expectations for these Brexit negotiations, but it has given people an excuse to buy a currency that clearly wants to appreciate a little bit, having been so oversold. And that's what we've done. We've taken us through this prior resistance level around 125 to 125.50. We have sprung above here. We've triggered the stops, which has helped spring us all the way up to around 120, just below 127, actually making now a new high, the highest levels since near on the start of October, so almost 2-month highs. For me, this resistance level around 127.50 through to 128.50 still is the line in the sand for me. That is still the point at which a crossing of that would suggest that the market has become significantly more bullish, at which point we could be looking even as far back as these 134s. But for now, the 128.750, 128 to 128.50 for me is still this, so 127.50 through 128.50 is still the major resistance for me. We've gone through the first moving average band, which is the 55 moving average. The 89 moving average again falls around that 127.50 level again, so strikes me as being another important level of resistance. So you've got this area here, 127.50, 128.50 for me is the line in the sand. A break of that would be quite bullish, and could see us trading back around the 134.50s, with initial resistance potentially being found here around 130.50, which was a prior zone of support here, and then resistance here on the way down. So it should be an important, or could be an important technical level on the way back up. Sticking with the pound, let's look at euro sterling and see how that's responded. Now, it's no surprise that strength in the pound, we are seeing therefore this move lower. We are still trading in this descending channel low, although we are testing the lower bounds of it around these 83.75 levels. If we break through here, then that would be quite a bearish signal, and we could be looking at around these 83.35s in the shorter term, or even 82.50s, which is the price support below here again. It's worth noting that we do also have the 200 and 233 moving average band coming in below here as well, which again is a important support zone. This will come in around the 82.50s once again, which makes that an increasingly important support level. But at the moment, we are catching a small bid or seeing some profit taken at the lower end of this descending channel, and it does seem to be holding up, at least for now. If we do see a correction back, then the next major notable resistance could be around these 84.65s to 84.50s, prior support turn resistance, of course. Beyond that, we could be looking around 85, which would be the top end of this descending channel. Sterling yen, we're looking now higher at around 121.50. Sorry, this is euro yen. Let's bring up sterling yen. GBPJPY, and I'm just going to zoom out to get all the information on the chart. And again, we have traded through that prior resistance, and we are now trading back into this moving average band, which I do think is going to be important. You've got the moving average band from 147 through till we've gone through 144, should I say. We're now trading around just below 145. Again, this is prior support. Let me just get a little trend line on here. Prior support during the way down, which makes it notable resistance around the 145 to 145.40 levels, and we're back in this band now. So this is where I'm looking for signs of exhaustion. We've seen a strong rally in sterling yen. I am looking for some sign of exhaustion around these levels, maybe identifying a possible correction. You can see that on the recent rally, the MACD histogram looks like it's losing momentum, potentially seeing a dip to the downside as well in the stochastic. If we take a look at the 4-hour chart, we're looking okay on the momentum front at the moment, so there's no sign quite yet that we are going to see that pullback. Clearly, this sterling move today has been quite a significant one, and therefore that would suggest that we may still have some more upside potential to come from this. But I think once we reach these 147s, then we could see that seriously tested, a breakthrough there, and all of a sudden things are starting to look significantly more bullish, at which point we could be looking at around these 150, 150s in the short to medium term, and potentially even beyond. I think we will wrap it up there. Maybe one more chart is the UK 100. The OPEC deal did provide a boost for energy prices, at which point you may be thinking, well, surely that's got to be bullish for the FTSE given the high exposure to the energy markets. Well, it is, and that's why we did see the FTSE actually rallying yesterday back up towards these 68.50s. But you've got to remember, more than 3/4 of the FTSE 100 generates its business abroad, and therefore when the pound fell after Brexit, we did see the FTSE outperforming the rest of the market, the UK 100 as it is on our chart. Correspondingly, when we do see the pound rally as we have in recent days, that is typically negative for these companies, and which is why, despite the rise in energy prices, we also have seen the FTSE fall from these 6850s to as low as below 6700, and why the pressure to the downside remains. If we do see a daily close below these two support levels around 6710 through 6730, then we could be looking back at around 6615, 6640, which is a very notable area of support since it broke above here back in July of this year. So that is certainly an important level to be keeping an eye on. That's all for today, guys. Do check out another video which we'll be putting out later in a piece on tomorrow's NFP. Tomorrow's NFP maybe not seen as an important release given the fact that the markets are heavily pricing in a Fed rate hike in December now. But in the video later on and in the piece which we'll put on MarketPulse, I will explain to you why I disagree that it's less important and why just as much emphasis is likely to be paid to the number both for December and beyond. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has got a lot of great tools designed to help you with your trading.